On today's show, 3 questions. Number 1, what is a market anomaly? Number 2, are you about to get scammed? And number 3, what's the difference between getting rich and staying rich? Welcome to Dentist Money's 2 cents. Welcome to Dentist Money's 2 cents, where we help dentists navigate all the noise. I'm Matt.
I'm Taylor.
And I'm Rabih.
You guys don't know this because it got edited, but that was my second take on this. And this is our second show of the day, Rabih.
Yeah.
So this is why I'm just stumbling over my words. This is a post-Christmas show. We already did our pre-Christmas show. I hope everyone had a great Christmas.
Yeah. Merry
Rabih,
Christmas, you guys.
Merry Christmas, everyone. Hope you had a great Christmas going into the new year. Rabih, what is a market anomaly?
Yes. So just as a disclaimer, because we're pre-recording this one, my initial question was going, are we going to see a Christmas rally this year? And then I discovered that this episode is going to be released after the fact.
Yeah.
I'm going to leave
I'm
it
glad
as
you thought of that before, because
Yeah.
I probably wouldn't have. Yeah.
So I'm going to leave it as an exercise to the listener. So you're listening to this right now after Christmas. Check the stock market. Did it go up? Did it go down? And did it go up because the news was saying there was a Christmas rally? On this segment, I'm going to walk you through like the history of market anomalies, which Christmas rallies is part of them. And we're going to talk about them, talk what they mean, and how they relate to a long-term investment strategy. So are you guys ready?
I'm always ready, Rabih.
Okay. So it's called a market anomaly, which means it's working against what we expect. So in a broad sense, there's no right or wrong. There's no right thing that says, oh, it should go up on Christmas, which is the 5 days between Christmas and New Year. Sometimes people include the first 2 days of the New Year. There's nothing that said should or should not. But we have a certain framework in our mind, a certain model. And when the market deviates away from this model that we have in our head, we call it an anomaly. And this model that we have is called the efficient market hypothesis. The efficient market hypothesis simply states that the markets are so efficient, you cannot predict them ahead of time. You cannot predict that they're going to go up during Christmas. But if that happens, and it has historically between Christmas and New Year, it's up a little bit around 1% during that time. They call it an anomaly because it is there. You can't prove that it's not there, but it does not fit into your model and your framework. So they call it an anomaly. But Christmas is not the only anomaly there is. We have something called the January effect, which means every January, small caps usually outperform and the markets is going up. We have momentum anomaly that shows up. We have turn of the month, turn of the year effect. We have what they call the post earnings and post merger effect. And all of these are certain indicators. Like when this happens, we expect the market to do well or do bad. Some of them are like September is the worst month, so it's always going to sell off in September. Or
isn't there one like sell in May and go away or whatever?
All of these.
Yeah.
Buy on the rumor, sell on the news. All of these are anomalies because during a certain period of time, the market did do well and they are repetitive. And I don't know if a Christmas anomaly is going to happen. 76% of the time in December it does, but we don't know if it's going to stay there. The most recent one where it didn't happen was in Christmas 2018, where actually the market went down around 18%. So we don't know whether it's going to show up, but there are a lot of hypotheses for why a market anomaly shows up in the first place. So for Christmas, it's not that people are going out there and spending. The market has already priced that in. What they think is the Christmas rally happens in relation to a January effect. So because people think that in January, because it's the start of the year, a new year, new me, people having their New Year resolutions, people are funding their retirement accounts because they just got unlocked for them to fund them. And companies have already closed their book for business and now they are making new initial investments for the year, indicating that January is going to be up. People, in anticipation of that, decide to put in money between Christmas and New Year. So the fact that they expect it to go up in January, it starts going up in December. So that is part of why a Christmas rally might be happening from like the infrastructure look at how our economy functions. Another one that we can think of, during end of November, early December, a lot of tax loss harvesting happens. And during tax loss harvesting, markets sell off because you are selling your losers. So the money has to be rotated back into the market. And it usually happens a couple of days before year end. And during that time, there's an upward pressure. The third one for a market rally in December might be due to the fact that people are on vacation and volume is very low and people are barely trading. So any big player coming in, they will have actually a bigger impact on the market and will let it ride up with no news coming in to be reflected into the price. So we've got a lot of these market anomalies that happen, and those are related to December. But there are much more others, so I'm going to...
It's actually, the last point, Rabih, is a really good point. I'm actually leaving out of town for Christmas, and so I think the market's going to be pretty quiet, just with the size of money that I invest.
Yeah,
I'm such a large...
Matt is leaving out of town, right?
I don't know what we're going to do without him.
Yeah, or what's going to happen?
We'll just close the New York Stock Exchange.
We just shut everything down. Let's just all take a couple of weeks off. Yeah, we might as well.
So the idea is that because we are humans, we have our behavioral biases, etc. There are institutional constraints on like when taxes can be accounted for, and there are delayed reactions. People can be in the market, can be out of the market. Markets aren't perfectly efficient, and those anomalies happen. And how does usually the market solve these anomalies? People come in and they arbitrage the opportunity away. So in a sense, they know that it might be going up in December, so they prep up their portfolio right now before this 5-day, 7-day period between Christmas and New Year. And with time, that anomaly must disappear. So we had one in September, it kind of disappeared. The Christmas one is still persistent. And I don't know if you can make a long-term bet or a strategy based off a market that might go up 1% in a certain week. How much can you risk money just for this 1% pop for it to actually be meaningful? Before I go into like the long-term strategy part of it, I actually want to highlight other anomalies that we thought are anomalies, but then were later on discovered to be just part of the system. And you guys are going to be, I don't know if you're going to be surprised by it, but when I learned it the first time there's a value anomaly and there's a size anomaly in the markets. They were always looking at the efficient market hypothesis and saying, well, if the markets are really efficient or really unpredictable, then if we invest in smaller companies, we do not expect to outperform. And if we expect to invest in value companies, which are cheaper companies compared to their peers, we do not expect to outperform. And then over longer term horizons, they actually saw that it is there persistent. You can't really give a bigger or more thorough explanation for the Christmas anomaly or Christmas market rally than what we just described, the three factors. But for smaller companies and value companies, relatively cheaper companies, there is an economic phenomenon and a justification behind it. That the one for cheaper smaller companies is that they are smaller in size. They have less access to financial markets and liquidities. Like a smaller company might not be able to just call up an investment bank whenever it wants and draft a way to create more bonds. There are constraints in the way business is done that makes it harder for companies to actually be as competitive. So smaller companies have a much bigger room and must put in much more effort to be able to compete at the same level as larger companies. And this, in a sense, this disadvantage is an inherent risk. And because it's a risk, investors should be rewarded to it. And that just justifies why more return is observed in small cap companies versus large cap companies. The one related to value is that what happens with small versus value versus growth companies is that those companies are usually neglected. People are usually, due to their herding behavior, just jumping after large, in this day and age, it's tech companies. It used to be like oil. People are jumping after tech companies and they are inflating the price relative to, the actual assets on the balance sheet of these companies. And because of that herding behavior, those companies are more susceptible to booms and busts, and the stock price fluctuates a lot. And we know the math of finance doesn't show us a lot of mercy. When you experience a lot of big downfalls, like losing 30% of your money, you need around 40% to make it back. When you lose 50% of your money, you need 100% to make it back. So it makes it much, much harder to recover when a big sell-off happens in growth. This leaves a lot of room for value to be purchased, ride smoothly, and compound returns that on the long run actually accumulate much more than growth. So there are a lot of anomalies. Some of them we can't really explain beyond some, small static stuff like the Christmas rally or the January effect. But there are other anomalies that are inherent in an economic system due to how we invest that we incorporate in, and we try to add to an investment philosophy for long-term return. So to summarize, in a sense, which anomalies are it, like there are anomalies, some of them are good, some of them are bad. Which ones are good and which ones are bad? And the whole idea is, if your time frame is long-term, you would want to understand that incorporating those anomalies might be there. But if your time frame is short, and especially when I'm talking about short as in, in a Christmas rally, I'm only expecting to make money over that week. But in a value strategy or a size strategy, I'm expecting to be making money over a 30, 40-year course of an investment period. So if the anomaly, between quotations, matches your time horizon, you may capitalize on it. But if it is small, it'll deviate you away from sticking course and sticking to a long-term investment strategy. So I don't know what Christmas did in 2024, and I hope it was up, and I hope people were invested the whole time and didn't just jump in because Christmas was happening.
This is awesome, Rabih. Yeah, I'm so glad you hit that at the end, because that's exactly what I was thinking about. Is like what was flashing in my head was like timeline, and this idea of like, are you a trader or are you an investor? If you're a trader, you care about Christmas rally and January effect and all this. If you're an investor, you don't care about any of that stuff. You care more about the premiums you're talking about in small and value. So super interesting. Taylor, what are your thoughts?
Yeah, I mean, I just was in a similar vein of like, I just never want my clients to be motivated by the timing of like short-term events, right? And if their motivation is like, I need to get this in before this event, then I'm like, you're just thinking about this the wrong way, right? Because, it doesn't matter about the short-term movements in a market. Like, I don't want you to put any money into the market that you're hoping for a short-term gain on. Because if you're depending on a short-term gain, then that means we probably need this money sooner rather than later, and you probably shouldn't be investing it anyways, right?
Yep. So true. That's such a good point. Yeah, and I think the other takeaway I got from that, Rabih, is like, if you can't explain it, then it is an anomaly, right? Like, if you can't give like a reasonable economic explanation, it's just like an anomaly. But you're saying like value and size premium can be easily explained with rational long-term.
Yeah, with economic models. I don't know how you put an economic model for the fact that the 5-day period between Christmas and New Year, the stock goes up. There are no news. There are no balance sheets. There's nothing you can refer to. And Warren Buffett says, if I don't understand it, I'm not investing in it.
Yeah. Yeah. That's a great just like maxim to follow in your life. And Taylor, you're kind of alluding to that. Like, if it doesn't fit your time frame, and Rob, you said that too, and you can't explain it, don't invest. So if you're out there thinking, oh my gosh, should I put more money in because of the Santa Claus rally? It's like, well, can you explain it? No, you can't. So then the answer is probably no. So I like that. Robbie, any other thoughts on this? Go ahead.
And no, I'll probably, once we resume next year, I'll actually hit whether a Christmas rally happened or not. What's your bet? Do you guys think there's going to be a Christmas rally?
I'm going to say pretty flat. That's what I'm going to say.
Taylor?
I mean, I would think just because we had a 3% drop in the market a day or two ago, that there would be some small rally, but it's just so meaningless, right?
It is very, very meaningless on the long term. No, I agree with Taylor. I think while December is still red, while December might not, no, what I want to say is that December is red because of that sell-off. While a Christmas rally might still happen, we don't think December is going to be overly green. It's just maybe break even or a little bit above. This is our expectations. I hope we're going to be wrong when we revisit this in a couple of weeks, because this just proves that you really can't predict the market on a very short-term horizon.
You know what I hope for more than anything? That no one even looks at it that's listening to this, I hope that they'll come back to us at the first of the year, and the first time they're even realizing what happened in December with markets is what we're going to talk about. Because that means they weren't spending any time on what's happening in markets, and they're spending all their time focusing on their families. That would be my hope. And also, I'm going to change my answer because Robbie agreed with Taylor. So I bet there's a rally. What
I heard, Matt, is he said we were both right. He said
I think you were saying that.
Yeah,
because that's what I was alluding to.
Yeah, he said
I think December Exactly. I think December is going to be as just the overall month is going to be flat. That's what I meant.
You know, what I'm certain of is that neither of us can predict what is going to happen. So what I'm going to do, and this is some game theory over here, I'm going to make sure that my answer is the same as yours. So we all fall together.
Perfect. My lifelong goal is just to always be on the same side as Rabih with everything. So whatever Rabih says, I'm like, that's it. I always have to go second. I always have to go after Rabih. Rabih, what do you think? Yep, sounds great. Okay, number 2 question coming in hot from Taylor. Taylor, are we about to get scammed?
Yeah, I think it's a
You're
great
like,
segue.
yes, by this show every single week.
So, speaking of families, right, and getting together with families, there is a phenomenon that's going to happen over the next 20 years. And by 2045, we're going to witness about $84 trillion of wealth transfer from the baby boomer generation to subsequent generations, right? And if you're wondering, that's 2.5 times more than the US national debt right now, right? So we're going to see 2.5 times the US national debt transfer hands over the next 20 years, right?
Wild.
They're calling this the Great Wealth Transfer, right? And, you know, all of us on this call probably are going to be affected this in some shape or form. So baby boomers are defined as people that were born between 1946 and 1964. My dad was literally born in the middle, smack dab in the middle, 1955. So he is turning 70 this coming year. So why this ties to being scammed is we have compliance trainings, required trainings that we have to go to just because of our profession every quarter. And most of the time, your eyes kind of glaze over and you tune out and you're answering emails while this is happening.
If the SEC is listening, that is not true. We are dialed. We're taking notes. We are so locked in. It's the best time of the year is compliance training. Yeah.
But, you know, we have all heard or we've gotten that voicemail from hey, your car's extended warranty is up. Please call this number. Or, you know, just like the classic scammers, the, you know, Serbian prince that needs your money. And we all kind of laugh at them. But this company that we hired to run our compliance, they periodically send out fake emails to try and get us. And inevitably, I'd say 25% of our company falls for each email that gets sent out.
I care not to disclose my scam rate.
So in theory, you know, we should be some of the most well-educated on this subject, and we still fall prey to these things, right? They're pretty good. You know, these scammers are pretty smart. And if you're wondering how good they are at their job, last year alone, about $28 billion was stolen or scammed from the older generation. Right? And this is only money that we know of. It's probably several multiples more than the $28 billion that was stolen because people don't really like to disclose.
I was going to say, they're talking about their crypto returns. They're not talking about how they got scammed by someone across the world.
So just when I heard these numbers and we were kind of going through this, it made me think of the Great Wealth Transfer and how this is only going to get worse, right? With this aging population, with the most wealth that's ever been amassed ever before, the scamming market is only going to compound and compound and compound. And so you may be saying, well, I'm not in the baby boomer generation. This doesn't affect me, right? Well, it does, right? Because you probably have parents that are in the baby boomer generation, or you have grandparents that are in the baby boomer generation. And there's a high likelihood that many of you on this call or on this podcast that are listening right now are going to receive some type of inheritance, which may or may not be affected by scammers over the next 20 years, right? And so it's just worth having a conversation with your parents or just checking yourself and making sure that you are staying up to date and aware of things and just being incredibly careful when anyone is asking for money in any way, shape, or form.
Yeah. This is a great topic, Taylor. I don't know if I like more, the topic or the fact that Taylor keeps alluding to this as a call.
Yeah.
Both are great, but no, I do love this topic. And this actually has personally affected me relatively recent. My dad's similar. He's a little older than your dad, but really on the earliest end of that curve of the baby boomer generation.
That's because you're, a little bit older than me, Matt.
Stop it. Don't stop it. According to you, I'm a lot bit older than you. He's on the early end of that curve. He was born in 1949, so turning 75 or just turned 75. And he actually, I won't go into the whole detail, but my brother walked in a couple of years ago to my dad really flustered, and on his computer, someone had like gotten into his computer. He'd allowed them access to get into his computer. And he was like trying to get to his banking stuff, and he was really flustered. And my dad's a very with it, very smart guy. And they got him because he's not although he is smart, he's not the most tech savvy person. And my brother walked in luckily and like immediately caught what was happening and didn't know the details of what was happening, but knew it wasn't good. As my dad is like kind of like scrambling to log in. He's on speakerphone talking to someone. My brother's like, "Who is this?" So my brother runs in, just rips the cord out of the wall for the computer, shuts it all down, and then hangs up. But this is so personal to me, and I can only imagine people listening have had similar experiences. We've actually had clients, we won't go into details, but we've actually had clients who have had this happen to them personally, where they've actually been scammed with like really, really sophisticated approaches to this stuff. So Taylor, I love that you brought this up. I think this is so critical to know now and be aware of, and it's only going to get worse. And Taylor, there's another factor, and Rabih, I want to get your take on this too, but you're talking about not only is the payoff becoming greater for these people, but technology. Yeah. I think AI is only going to make this more dangerous. And Rabih's nodding. He knows. He's like, I'm developing 100%. Something right now, actually.
100%. Yeah, you might not like to share your inheritance with a scammer. Who would? But if a scammer is using an AI that sounds like your brother, well, probably if you love your brother enough, you might share your inheritance.
He's like, I'm like, which brother? Which brother?
Which brother? But you are more prone to sharing your inheritance with them, even if it is unwillingly. So, yeah, and I love that Matt opened that door in this conversation. AI is going to become, we are already there, where it is so hard to differentiate between truth and false. I have my mom that every time she sees a reel online can't differentiate whether it is a real video or artificially generated. So it's going to get harder, and it's going to be, because there's still no regulation and they are way lagging in terms of implementing, safeguards that would really protect investors and consumers. It is up to us to put on the hat of the protector for our own selves and for the vulnerable people in our household that, might wait us. Like, I would worry less about making an extra 5% and make sure the inheritance is still there to start with. So, yeah, it is a call to action, and it is probably something to be worried about, and a healthy thing to be worried about.
And just to kind of bring it back, because, I think we're doing a good job of scaring people. But if you're looking for
our favorite thing to do on 2 cents. Yeah. Yeah.
I think if you're looking for tangible things that you can do, is just never ever share any sensitive information or any banking information or any type of financial data via email, right? And we try and preach this to our clients, but gosh, our clients send us some of the most sensitive things. They're sending full bank account information and numbers to us via email, and we try and beg them not to do it, but people do it. So if you're listening to this and you're worried about it, just please make sure you're never sending any sensitive information via email. And anytime you do make a transaction, just confirm it, call the person, call your advisor. Do not send any sensitive information via email, or do not listen to anybody that's calling you and start giving them information if you do not know the source.
Yeah. Yeah, I think that's a great thing, Taylor. And I think, too, where scammers get people a lot lately, and again, Rabih, as you said, AI is getting so good at this, and we're already there where it's really hard to decipher. But I think as a general rule, if you're getting a proactive call from someone claiming they're from some place, whether it be, in a government organization specifically or a bank or whatever, and they're proactively asking you for information, that's not your bank. That's not your institution. They don't do that. They don't call you and say, hey, I need your account number, or hey, and the FBI or whatever three letter government agency does not call people, doesn't call us and say, hey, we're, actively trying to like stop this person. We need your help. So I think whenever it feels like off, just generally, you're like, this is really out of the blue. This does not feel right. You got to bring someone else into the fold, meaning a spouse, a friend, be like, I just got this call, or this person's reaching out to me. What do you think? Or call your bank yourself. So be like, I'm going to hang this phone up and I'm going to go call that institution separately. Again, we're not trying to like scare you and saying there's nothing you can do. We're saying you should be more probably worried about this than a lot of people are, and just take cautious steps when something like this happens. And Taylor, to your point, try to be a little bit more careful in sending information like this.
And talk to your parents. Like, educate them, because honestly, my dad, he was a successful attorney, ran a business, and I would say a very bright individual. And like you said, Matt, he's fallen prey to several of these scams. And just when he turned 65, the number of scammers that have been calling and trying to do things and get emails, it increases exponentially. Like, they know how old you are, and they know you're susceptible to these things after a certain age. So if it doesn't apply to you directly, like, have a conversation over the holidays with your parents and just make sure they understand these things as well.
Yeah, it's a great point. Rabih, anything else you'd add to this?
Yeah, no, I love the education point. And it's not really their fault. It's just like the technology is advancing at a much faster pace than the environment that we grew up around. But I think a big part of becoming better and more prudent with your online footprint is to take it out of this abstraction of the internet and like think of it in terms of like common sense. When people throw out their phone numbers on random forums on the internet, this is the equivalent of you, I don't know, changing your clothes in a public bathroom with no lock. Like, how ridiculous does that sound? But this is the same thing as just throwing out your information out there. Or like, how comfortable would you be if you're driving on a highway back to your house and there's a big billboard with a birthday picture of you? Like, you don't want that. But this is the equivalent thing of you posting your information on websites or replying to emails not knowing who the source is. Like, it does not feel comfortable in real life. It shouldn't online as well.
Yeah. It's a great analogy, Rabih. Yeah, so to finalize this point, we're not saying be like Ron Swanson from Parks and Rec, although my favorite character on that show. We're not saying you have to go to those lengths, but please
don't buy gold.
Yeah, don't buy gold and bury it in your backyard, but just be more aware. I think it's just more creating awareness and try to be educated on it. And if it doesn't feel right, just kind of take some extra levels of verification. So, okay. That was awesome, Taylor. Thanks for bringing that. The last one, what's the difference between getting rich and staying rich? This is one of those topics that could be a whole other podcast, and we probably should talk about this separately. But I just came across this article and an interview with Mark Cuban that I thought was interesting, and I thought brought up a fun conversation around stuff that we do every single day around helping people invest and build wealth and keep their wealth. But he told a story recently where he sold his first company called Micro Solutions back in 1990. He was he was late 20s. He was 27. Also, I love these stories because they always make me feel really crappy about myself, about what people are doing with their lives, like 10 years younger than me. But he sold his first company. He walked away in 1990 after taxes and everything with $2 million roughly. And he immediately called his broker. And this is an exact quote from Mark Cuban. He says, "I want you to invest for me like a 60-year-old. I don't want you to invest like I'm young because I want to live off this for a long time." Now, we all, I think, know generally what Mark Cuban's gone on to do. I think there's that irony here that we'll talk about, but we all know he's now multi-billionaire, owns the Dallas Mavericks, private jet, all the things. But I thought this is interesting, and I wanted to just have the conversation be around this quote and this thought, around the idea of, like, again, the risk you take or the things required to get rich, or I'll say maybe differently, to build wealth versus maintain their wealth. I'm going to leave it there and throw it to you guys of your thoughts. Rabih.
I'm waiting for Taylor to talk.
I know you are. You both are. I should use a name.
It's interesting as an advisor because you have these conversations with so many different people in so many different walks of life, right? And so I will have a conversation with someone in their 70s, and then an hour later I'll have a conversation with someone in their early 30s. And it really is such a different mindset and you have to have different expectations when you're dealing with someone who is an asset accumulator versus someone in wealth preservation stage, right? Specifically, I was talking to a client who is in their late 60s, and they were like, I don't get why the S&P 500, got 25+% return this year, and my portfolio got 12, right? And it was like, well, we're just invested differently, right? Like, we aren't trying to get S&P 500 returns because we're not trying to grow your wealth. We're trying to preserve your wealth, and a bunch of your money is not invested in the S&P 500 because that's not the hope. The hope is not to get these outrageous returns. The hope is to preserve your capital so that you can live off of it for the next 30 years.
Yep. Yeah, these are the years that those hurt, right? Because they see it cut in half, but what they don't know is if in years like 2022, when the market's down 19%, they're flat or maybe up, depending on the situation. So that's a great point, Taylor. Rabih, what are your thoughts?
Yeah, no, to add on that, I have this analogy in my mind that I always use and I really like it. I think of investments and creating wealth and maintaining wealth as sort of a big water tank. What happens is that you can control the stream of water going into the tank, and you can control the stream of water going out of the tank. And the size of the tank, whether it's, I don't know, a certain volume or much bigger, is not controlled by you, it's controlled by the market, right? So what happens is when you are accumulating wealth, you are hoping that this incoming stream is as strong as you can and as heavy in volume as you can. And you are hoping that the market is growing and the tank is growing in size to accumulate the biggest amount of water in the tank as you can. But then when you are not accumulating wealth anymore and there's no inflow coming in, all your worry is about how big of a stream is going out. And when the market shrinks and there's a downfall, you don't want it to squeeze more water out. So it's a lot of work on figuring out how thin is the stream coming out and how much water am I losing per day or per year from that tank. And if the size of the tank starts wobbling back and forth, does it squeeze a lot of water out? I don't want it to go out. So a lot of the asset allocation is to maintain the size of the tank in a thing that is stable so you can control the stream out and try to make as much use of the water that's in the tank as possible.
Yeah, I love that, Rabih. And I'm just sitting here thinking, and Taylor alluded to it as well. I think one of the most underrated parts of all of this when it comes to financial planning, we see this all the time, is the mindset required and the complete behavior shift. And again, mindset and approach to that analogy you're talking about, Rabih. Like the mindset and skills and approach to filling up that water tank is completely different than trying to get that water, like trying to extract water from the water tank. Psychologically, emotionally, tactically, there's so many different ways to shift. And I truly do think this is one of the most underrated parts of our job, or just advisors in general, of preparing people prior to them shifting. And kind of, if we're going the traditional route, let's say it's not as much in dentistry, because we have a lot of dentists who will quote unquote retire, sell their practice, and then work back a couple of days a week or a day a week or go teach or whatever. But let's assume for a moment you are transitioning completely. You're going from the CFP answer, you are the accumulator, you reach the top of the mountain, and now you flip the switch and you are now a distributor, right? You're now pulling your assets. Just the psychological and emotional toll that takes of being like, I have no paycheck coming in anymore. I filled this water tank and now I'm pulling water out of it. Like that takes some prep. That takes some psychological preparation years before you actually retire. And so I'm glad we brought this up and talking about this different skill sets. And Taylor, I love that you talked about the investing portion and knowing that even psychologically, when you're in that stage of being like, well, I'm seeing all these headlines, I'm talking to my kids or my nephews or whatever, and they're talking about their returns. And I'm sitting here being like, well, what the heck? Why am I only getting this? You're playing a different game. And I think that can't go understated.
Well,
any other thoughts? Yeah, Taylor, go ahead.
I don't know if you were going to... There's a famous quote by Mark Cuban where he says, diversification, that's for idiots, right? And it's taken out of context a lot when people are talking about diversified portfolios, right? But the point he was making is if your hope is to grow wealth, and Warren Buffett said as much as well, is, when you're trying to grow wealth, concentration is really important. Meaning like for our clients who are dentists, they need to be very concentrated in dentistry and building their practices and being the best dentist possible so that they can grow wealth, right? But diversification is very, very important for preserving wealth, right? You don't just want to be tied to dentistry in retirement, right? You want to be tied to a lot of different things because wealth preservation is very different than growing wealth, right? So it's so different, to answer your original question, like becoming wealthy and staying wealthy are just two completely different mindsets.
Yep. Taylor, I'm so glad you brought that up too, because I know that quote. People have brought that up before, and we've seen that on social media or whatever. And my counterpoint to that, kind of alluding to what you said, is concentration in the things you know and diversify everything else. And that's kind of the point, is when he's saying he's an entrepreneur. He's a tech billionaire. He's built multiple tech companies. He's just founded another one, I think, relatively recent. He's concentrated in the things he knows. He knows how to start tech businesses. That's what he does. So he's all in. And that was the irony I was alluding to earlier, is he makes all this money and says, I want to invest and take no risk. I want to invest like a 60-year-old. But he's taken so much risk since then running his business, building up these businesses to become a billionaire. But that's the whole point. And I'd love that you said that, Taylor. I think this gets conflated a lot with dentists. We yes, definitely go all in on dentistry. Like, please go all in on dentistry. Don't try to go all in on real estate or think you're going to go start another profession. But then everything else you do from an investment standpoint, diversify. That's a really good distinction there. Rabih, I'll give you last word on this. Or go ahead, Taylor.
And that's the point here, is like the wealth generating tool for our clients is their dentistry, right? And that's when they're concentrating, they're growing and building the wealth, right? But preserving the wealth is through diversification.
Yes, totally.
When they're building the wealth, it's coming from their main driver, which is their profession. And the way to preserve the wealth that you're building is to diversify it.
Yep. Love it. I'm so glad we brought this up because this is a key distinction. Rabih, go ahead.
Yeah, no, we've talked about this in terms of like the return of it, but there's also the risk aspect. There's the risk aspect of creating the wealth, and there's the risk aspect to maintaining the wealth. The risk in the creation phase is that you're not making enough, right? This is the risk. Like, you are not being the best dentist you can be. Your P&L could be optimized. Your reach to clients could be optimized, etc. So during accumulation phase, the risk isn't that they are fluctuating in value. The risk is that not enough stream is coming into that tank. Whereas when you're in the maintenance phase, it's a different type of risk. The risk is that you are losing so much so quickly, or a lot of stuff are out of your control. So it is hard. We're not expecting people to like listen to this podcast and be like, oh yeah, now I get it. Now I'm able to transition really well from being an accumulator to a distributor. No, we're here to help. But the idea is, this is not a conversation you have the day or the night before you retire. This is a conversation you have over a really long period of time. And that's what, guys are here for.
Yeah, love it. I'm going to finish with this. Mark Cuban, when he sold that business, he had 5 roommates sleeping on the floor, driving a 1966 Buick LeSabre. He said he kept living like that after he sold. He said he bought the worst house, the worst house in the best neighborhood. He said, I wasn't really into that. Exact quote, I wasn't into big cars. I wanted to live like a student and just have fun. Fast forward, he also now, fast forward to today, or I don't know when this was, relatively recent, he set a record for largest single e-commerce transaction in history. He bought a $40 million jet after becoming, I guess, online. It says he set the record for largest single e-commerce transaction in history by buying a $40 million jet online. So quite the journey for Mark Cuban. I thought that was interesting. But any final words on this, guys, or anything else we talked about as we wrap up 2024?
Happy New Year.
Merry Christmas.
Merry Christmas, Happy New Year. This is our last 2 cents of 2024. We plan on doing many more in 2025 and beyond until people tell us to stop. We will keep doing this. So thank you, everyone, for listening. Truly, it's been a wonderful 2024. We really appreciate the support, and everyone, we hope you are getting value out of this. Rabih and Taylor, thanks for being here. That was our 2 cents. Last thing, I got to get the calls to action, of course. Dentistadvisors.com if you want to talk to us. We also have our summit coming up. If you're sitting here thinking, I love what these guys talk about. I love Dentist Advisors. I want to hear more and maybe meet them, meet my advisor, or just come and be inspired. Our second annual Dentist Money Summit in Park City, Utah, June 20th and 21st in Park City, Utah. We'd love to have you there. DentistMoneySummit.com. For now, that was our 2 cents. Happy New Year, everybody. Till next time. Bye-bye.